your financial advisor. That was loud. Two-time author, one-time bestseller, and we are here to talk about the stock market. There was some very good news coming out of the market today, so we're going to discuss that. But first, grab your phone, go ahead and hit the share button, and then we're going to talk about A, what happened in the news today, and then B, what is this thing that you have to have if you want to be a successful investor. So I am going to grab my phone now, which is what I'm doing. I'm going to hit the share button. You should do that as well. And then, as always, I will sit here and monitor the comments so that I know what's going on and make sure that you guys can hear me and all those types of good things. All right, so I have shared because I practice what I preach. You should go through and share as well. If you have any questions, you guys know the drill. Let me know, and then I will address it now and do the best I can. Let me also throw out, because I'm scrolling through my own timeline right now, if you got my email from earlier this morning, my bad. I made some typos. I absolutely hate typos. So please forgive me. I am not a perfect person by any means. But if you have toddlers and things running around the house, things happen. So I apologize for that. I will definitely slow down in writing my emails. So that aside, before we get started, this is the Ivy Investors 7 Streams of Income Summit. I am not a part of it, but I am very excited about it for a few reasons. One of my biggest investing secrets is having multiple streams of income, and I would not be able to fund my son's account and do my Roth IRA and do all these other things if I didn't have different streams of income. One income stream is my books. The other one's the class that I teach. Another one is public speaking that I do. It used to be traveling to schools and doing things like that, that nature. Sometimes it's writing blog posts and articles for other companies. So each of those streams have a job, and that is a great thing about being an entrepreneur, but also just having different buckets to pull from when you need to. So for example, all the book revenue that goes to my son's account. I used to have a vacation fund. Clearly, vacation is closed. So one of those buckets went straight to vacation fund. Another went to go buy stupid things. And by stupid things, like I bought a new college sweatshirt just because that's just what I do. I just really love college sweatshirts. I have a stream of income just for that. Then we've got savings. Then we got a whole stream for bills and all of those things. And especially in this environment, when a lot of people's 9 to 5, their main income was shut down completely or greatly affected. I've had clients whose salaries were cut 30-40%. And I've got clients who just lost their jobs altogether. Those who had a second stream or a third stream, they were able to kind of pull things through. And that's what you want to try and have and build. And this panel of experts, I've met I'll point them out. 1, 2, 3, 4 of them I've met with and or worked with, and this will be an incredible summit. So go to buildingbread.com/streams. I can almost guarantee you that you are going to get your money's worth. Tickets are between $97 and $147. I'm telling you right now, it is definitely worth it. Quick story before we go into it. I'm sure y'all know Courtney. I've done a few summits with her in the past. When I have a question and I don't know, Courtney is my go-to. That's how good she is. Terry, she's a day trader. We don't cover day trading here, but she went to MIT and she's smarter than I am. And she makes on average $1,000 every day in the stock market. So if you're looking for more of the day trading stuff, she's an expert. And then Letitia Stiles. I would not be here without Letitia. She has helped me to build my entire business to a point where it actually makes money. So with my consultations with her going all the way back to 2016, I've made close to, I said 20,000 earlier, but I went back and actually did the math, and it's close to like $35,000, $36,000. $35,000 to $36,000 I've made from working with her. So you can go through and check all of the other things they do. They talk about rental income, they talk about investing, they talk about trading. Some people talked about options. Options will be covered because that's kind of what Terry does a bit there. So you'll get the recording, you'll get all that. That's my spiel. But you're gonna get your money's worth if you go. So that's just my quick commercial. Let's go ahead and get into today's topic. All right, so there are a lot of things that happened today, primarily right here. The S&P 500 got very, very close to its record high, which means it ain't been this high before, which is pretty good news for investors in general. Now, why did it happen? Obviously, we talked about Tesla. That was a big mover. Apple, I believe, was a big mover as well. We can click and see here, but the S&P 500, for those who may be new, that is pretty much the 500 largest companies in the US. So any company, usually any company that you can immediately name, Walmart, Microsoft, whatever it is probably going to be in the S&P 500. Tesla is the only exception that is like a quick brand name that may not be in there, but that is considered to be their next move. They have met the criteria. We don't know when that day is going to be, but that's highly anticipated. So the tech stocks tended to move this up closer. This is actually up in front of my old job. That's funny. But this is a good thing for investors. Why this is occurring? Expectation. We expect the economy to return. We expect tech stocks to do better in the long term. It's really expectations, not the actual economy. So we've done a video on that. But I do want to tell you this: if you do not have a process, if you don't have a process, even when the S&P 500 is up or Tesla is up or whatever stocks you're looking at, if you don't have a process, you're not going to do well as an investor. And more than a process, you need to have a structure. You need to have a real concrete structure when it comes to how are you choosing your stocks, how much money are you putting into those stocks. I should really write these down. I will in a second. How do you choose those stocks? How much money are you putting in, and what are you deciding to do with them, and when are you deciding to do that? So I'm going to try and illustrate this a bit. Y'all know my illustrations and like when I write things out, they aren't all that great. So bear with me, but y'all have been here before. So what we need to have is, number one, you need to have, we'll just say structure. So that's what you need. And when you have structure, you need to have a few things that work along with that structure. So number one, what are we, and hopefully y'all can see this as I'm writing. I think you guys can. What are we investing in? And feel free to take notes as we're going through this. Your structure and whatever, like everybody's structure is going to be different. Some people really care about dividend stocks. Some people really care about stock options. It doesn't really matter what it is, but you need to have a process, and you need to have a process for what you're investing. What are you investing in? If you do not have this, then you're just going to invest in just stuff because people said it, because you saw it in the Facebook group, because you think it's going to do something, and the process is not going to be consistent. And then you had to have number two. So we got what we're investing in. We've got how much money are we putting in. All right, that's number two. I don't want to talk and write at the same time because I'm definitely going to make some stupid mistakes if I do that. And then number three, when are we selling slash, evaluating? So these are the three things that you need. And let me see if I can do this, and now we can, there we go. We can see each other at the same time. Or I can see me seeing you. I guess is what it really is. All right, so these are the three things you need. What are you investing in? What is going in and how much money is going into it? And then when are we selling and or evaluating? If you don't have a structure, you're not going to make it. Because again, yesterday we talked about Tesla. Now again, I have a structure. So and you guys have heard me talk about these rules. My thing is the company profitable? They were. Do they have momentum, meaning that the stock is actually moving in the direction I need it to go? Which it is. The only thing that was stopping me from investing in Tesla is I just didn't like Elon Musk. That was it. I do look at CEOs and say, do I trust you or do I not trust you? I still don't trust him. But I have all of these things in place. What are we investing in? Maybe it's Tesla, and it's still a maybe, right? How much is going in? I've always talked to you guys about my 5% rule, and I'll explain that and kind of draw that out in a second. And then what are we selling and when we evaluating? You guys know that I personally have a 6-month process, which means I'm picking it today, and in 6 months, I'm going to come back and decide, are you still good or are you not? Because over 2 weeks, over 2 months, a stock can be flat. We can just do this. It can be just like this, not doing anything, and then start to take off later down the line, right? You never know. But if I just say, well, it's a bad day, I'm just going to check the market on this day and get rid of it. That's not how the market works. Because if you did this back in March, you would have sold everything, and you would have been sitting outside looking stupid while the market is up and while it almost hit a record today. So, you would have missed out on all that. All right, so let's kind of look at what this means. So my 5% rule, and we talk about this in my class, is that outside of your index funds, so take index funds out of it, you can put all your money in index funds. No expert is going to hate you for that. But outside of index funds, if you're investing in individual stocks, so if you want to buy Microsoft by itself or Google or whatever, Walmart by itself, the rule is you should not have more than 5%. And that's the key word. You can have 2%, you can have less than that. It doesn't really matter. Once you start to creep up above that 5%, you're starting to take on a little bit more risk. Because if one stock, let's say we all bought Tesla, right? And the stock went up. That's great. But if Elon Musk says something stupid and it doesn't go that way and it goes down 50%, then guess what? That was only just this tiny, tiny fraction of my money. I wasn't hurt overall by that. And the reason why I bring that up, especially about Tesla, is one, it's popular, but I also want to show you this too. Let's see if we can pull it up. I prefer Yahoo Finance, but this will have to do today. All right, so let's do year to date because I want to be realistic and talk about what happened in real life, right? All right, so this is actually, let me do 1 year because a lot of people are talking about Tesla and the split, and I too am also interested in that. So if we go back one whole year, Tesla down here, you can see in this left-hand corner, $200 a share or so in 2019. It went all the way up to about 700. So from September 2019 to February of 2020, you went from $200 a share to close. Actually, it says it's closed at $800 a share. That's incredible, right? You're at $800 a share, and we call this anchoring. When you say, well, this is what I bought, and I'm always measuring it by this thing, and things don't necessarily move, right? So if you bought in February at $800 a share, how are you going to feel, or how did you feel in March when the stock was down to $430? You started at 800 and now you're at 400. You feel really bad. That's half of your money gone. Or if you put in 50% of your money in Tesla and you lost half of it, you're not feeling so great. And most people don't hang on after that. We talked about AT&T and how not great that has been. Imagine if you had Tesla and it's down by this much. We were talking about AT&T, and many of us, and I'm not going to disagree with you because I got out of AT&T early in the year before it dropped as much as it did, but we were talking about AT&T and like, look, I'm going to let it go. You probably would have let go of Tesla too. And AT&T is not Tesla. So let's not, I don't think that AT&T is going to recover in the same way. But it's a good example of how your mind may or may not play tricks on you. So at this time, in March, when everything was down, Tesla was down by half. Then it shot up, and we're looking at it's back at 800 again months later. Now it's at like 1,500, right? And now it's going to do a stock split and all this stuff will readjust. But the thing is, it's all great and fine when you know it's going up. But when this happens, when it's down by half, how you going to act? And that's where that structure comes into play. So when we have that structure, got at AT&T yesterday, and look, I would have done the same thing. I would have done the exact same thing. But this is why I do that 6-month process. So again, and this is just my process we talk about in the classes and courses. So let's say that we bought Tesla in February and it dropped down to half. That's fine because I'm really gonna wait. 6 plus 2 is 8, so I really wouldn't come back until now, August, right? So all of this little temporary stuff would have happened, and it actually would have been up. Look at that, in August, and been fine. Would have been fine if you waited 6 months. Now, that's not a magic number to say that 6 months from now that everything is going to be fine. That's not the case. You can clearly go 6 months back from March, and actually in this case, you still be up. You would actually still be up. So we got 1, 2, 3, 4, 5, 6. So September. So for March to September, you would have been, you would have gotten in at 225. You would have been here, still up 4 to 500. So you're still up in that case. But a 6 month rule kind of keeps you at a good pace, keeps you at bay, and again keeps that structure alive. I am checking to see, just double check and make sure that we did not go off air. Give me one quick second. Okay, it looks like everything is fine. My phone just glitched out for some reason, so that's never a good thing. All right, so again, that 6 month time frame is not always perfect, but it allows you to cool off as a part of the structure. So when we pull this up and we talk about when are we selling, when are we evaluating, we know that in advance. When you have a structure, you're not usually emotional. And you say, oh my God, I'm down, I'm selling. Well, why are you selling? Because it is my rule, it is my process that I sell on the first of every month or something like that. Or I sell on, every 6 months or every year. Doing it once a year is fine, but that is a part of your structure. Also, again, since we're talking about AT&T, if you only have 5% of your money in AT&T, now, we don't know what everybody has, but if you limited it to just that 5%, it may not be that bad because I got 95% of my money in other things. And this is why you want to have that structure. Again, everybody's structure is going to be different because we're all different people. We're looking for different things and we have different goals. But you have to have a structure for each of these questions. Now, we cover this in my course, but again, everybody's is going to be different. Now, one way that this structure works, which is why I brought up the S&P 500 to begin with, is this. So let's just say, and this is just an example, this is my money, okay, or my investments, really. And let's say we have y'all know I'm terrible at drawing. So let's say we've got a pie here. And my structure, and this is just an example, that my structure would be something like this. So let's say S&P 500 index funds. And I don't know what percentage that is. You could call a third, whatever. So let's just say that my structure is this percent of money is going to S&P 500 index funds. We'll put percentages on it in a minute. Then we can say this is bond funds. Eesh, that doesn't look right at all. Bonds, and then we can just say individual stocks here. So this is an abbreviation. This is individual stocks. Don't look up INDV. I have no idea what that is. And we can just say, whatever stocks that we want, we're going to add here. And I'm going to, again, make up numbers. Let's just say this is 60% of my money. Again, I'm making this up. Let's say this is 20% of my money. And this is not proportional, clearly. And this is 20% of my money. And this is, I'm gonna leave it like that. It's not proportional. I'm sorry. I know this bothers some people that this 20 and this 20 is not the same shade. It's okay. But this is just an example of structure. So for me, again, you choosing individual stocks, it's fun, it's sexy, it's going to grow your wealth if you do it right, but it's also a little more risky. So if I got the S&P 500, I'm going to be fine regardless. If I invested in Tesla and it doesn't work out, guess what? The vast majority of my money is still here, right? In fact, the vast majority of my money is really here and here. So I'm still going to be okay. And this gives me space. If I stay with that 5% rule, that means I can only invest in 5 stocks as a max. Now I can easily say, well, let me get 1% of each of these, and that means I can have 20 stocks. So it's all up to you. But again, this is structure. It kind of builds and protects me no matter what happens. So let's say that the whole stock market is down, right? In a situation where the coronavirus just didn't do well, guess what was down? S&P 500 was down, individual stocks was down. Guess what was not as bad were bonds. So at least something is helping me and giving me some cushion when things aren't going well. Well, what happens when bonds aren't doing well? Well, it says again, SP 500 may not be doing well, but guess what? Microsoft, Tesla, Google, Netflix, whatever, those stocks are doing well, or even more boring stocks. Procter and Gamble, Kroger, Walmart, those are doing well. Guess what? That's what's going to protect me and can make me more money than these other two areas combined, depending on how I'm investing my money. Now, again, your structure, let me do this. This is worse than the first circle that I drew to begin with, but it does give me it's worse. But this does give me a structure to work with. So it helps me to answer these questions about, well, what am I investing in? Well, I have 60% of my money in the S&P 500. I've got 20% in bonds. So that means that this other 20%, I need to decide how I'm going to divide that up. How much is going in? I already know that 60% is going here, 20% here, 20% somewhere else. And then I get to ask myself, when are we buying? When are we selling? When are we going to evaluate? And these are questions you have to answer for yourself. What I'm showing you on the screen is literally just an example. So please don't take a piece of paper and go to your Fidelity account and start dividing things in this way. There's actually some math and a process into what goes where. This is literally just an example for you guys just to understand what goes on behind the scenes and how an example of how you want to go through that for your investment strategy. But if you don't have it, number one, thank you for coming out. Make sure you share the video and you can start to figure these things out. But if you don't have it, what people do is you get in, you buy stuff, you don't like it, you sell it, and you turn around and like, oh, what happened? You want to have a process. You have to have those questions so that when you go into the market and you know what you're buying, you know what you're doing and why you're doing it and when you're going to make those decisions. And you have to let time play out. Because as we've seen with Tesla and nearly any stock, you're going to hit a rough patch. You're going to hit a rough patch. But if you don't have a process, you start to make those mistakes. And just like I showed you here about the 6-month process, you can even do it over a year. If you bought it 6 months in what it was, September, whenever it was, 6 months in March, even when the market was down, you still would have been up double your money. You got in at 200, it fell, but you're still at 400, so you're still good. That's an anchoring piece. If I got in at 800, it fell, but I still didn't wait my 6 months. I need to wait and let things grow, and I actually would have paid off here. Now, that does not happen every time. That does not happen every time, but I wanted to give you an example just to see how that may work. All right, question time. Have you went over ETFs or how ETFs work? What is it? I may have missed it. I didn't do an entire thing about ETFs, but we can talk about it here. An ETF, just because I'm in the writing mood today, I need to be writing this book and quit playing. That's what I need to be doing. So ETF stands for exchange traded fund. And y'all know my handwriting is terrible. All right, so it stands for exchange traded funds. All the letters are there. And what that is a collection of stocks. Sometimes it can be a collection of bonds. So instead of me trying to go and find all the best stocks, I can get an ETF that has all of those things together in one package. So I don't have to go, like if I want to invest in technology stocks, I can either go and try and find 20 or 30 or 500 technology stocks, or I can say, look, I'm just going to go get an ETF and just go do that. So it saves you time and it is a little bit safer. So instead of you putting 10% of your money in one stock, 15% of your money in one stock, you can get an ETF and it's going to put its money into hundreds, sometimes thousands of stocks at a time. So it is considered to be safer, and it's an easy way to invest in thousands of stocks at one time without you having to go through the process of worrying about, like, is this the best stock? Is this going to do okay? What happens if this happens? Blah, 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 blah. So that's what an ETF is. I have VTI. Is it okay to purchase another ETF? Great question. VTI is one of my favorite VTIs. VTI is one of my favorite ETFs. For those that don't know, is the Vanguard Total Stock Market Index Fund. It is an ETF, and what it does is invest in the entire stock market. Every single stock is inside of that ETF. Now, if you want to buy an additional ETF, that is okay. However, you don't want to buy the same type of ETF. There is no benefit of having two stock market funds that do the exact same thing. Now, if you told me I'm going to get VTI and maybe I'm going to get a technology ETF, okay, that's a little bit better. You're going to get VTI and I'm making this up. I don't know, a consumer stock or a consumer ETF or an oil ETF. Oil probably not gonna make you any money, but you get the point. That may make sense, but remember, you're still having what we call duplication. So let me show you that. I feel like I am going to school today, which is fine by me. All right, so let's say you have VTI. VTI. Again, for those that don't know, this is an ETF. Let me take off these periods. VTI. Okay, so this is an ETF. It owns the entire stock market. So this is, total stock market. So you pretty much got every single stock in existence, at least in the US. Now, if you go getting another ETF, totally fine, but do know that you could have what's called duplication. So let's say if you have a technology ETF, guess what? This much of it, you're going to have in technology. So you have, let's say you have a little bit of Apple in your VTI, you're also going to have it in a technology ETF. So you have it twice, which is good because if the market goes up, you're going to be good there. So you're going to get in your VTI and you're going to get in that technology ETF. The problem is, well, if it doesn't go your way, then you're hit twice. So you can do it. People do it all the time, but that's the balancing part of it. If it goes your way and you have a good ETF, just know that any technology ETF, and I'm telling you this right now, almost every technology ETF is going to have Amazon, Apple, Google, Netflix. Those are good stocks. But if you got Amazon, Google, Netflix, and your Vanguard Total Stock Market, and you've got in the tech one, you can do either really well or you can do twice as good or twice as bad. So that's the only thing you need to worry about. All right. If we max out a Roth IRA, what account should we open to continue investing? Traditional IRA or just a brokerage account? If you max out on your IRA, you are, unless the rules change, I don't think they did, you cannot max out on your Roth and your traditional. They do not allow you to do both. You can only pick one or the two. Since you've done the Roth IRA, if I had a choice, that's probably where I'm going to go. Then your best bet is probably your brokerage account, unless you have a plan at work. So maybe you have a 401k or a 403b. If they match, you definitely want to go there. So that's probably where I'm going to go next. So if I've already maxed out my Roth IRA, I'm going to look at work and see if that is an option for you. You may have it, you may not. If you don't, then you want to go to a brokerage account. There is no limit. There's no limit to what you can put into a brokerage account, but you do have to worry about taxes there. I wouldn't be too concerned because it's not like, I don't think, unless you're doing the most, right, you don't have to worry about taxes there. So you're not going to get a dumb tax bill, but you could get a 1099. You may have to pay taxes there, depending on what you're trying to do. All right, can you scroll up to my question? Thanks. Thank you for reminding me. I am going to do that now. All right. So the cool thing is when you guys share and you comment, like you get a top fan badge. So like I can easily go back and find her question. All right. I have yet to sell any stock. How does a company like Schwab make money if I sell my stock? That is a great question. In most cases, Charles Schwab, if everything is what I read was correct, they don't charge you any fees. So Schwab actually doesn't really make any money off of your, when you buy and sell, most of these apps, Robinhood included, don't make money when you buy or sell. They don't make any money off of that. They used to when they were charging you $10 a trade. But Schwab doesn't make any money off that. Schwab makes their money from a few different areas. If your retirement fund is at Schwab or like Fidelity, they make their money there. They make their money by creating 401ks, and they make their money in ETFs. ETFs like Vanguard, there is a fee for that. It's built in to the share price and everything else. And they're usually pretty cheap. Like I ran a webinar earlier today, and it was for 10 years. 10 years, if you put your money into like one of those Vanguard funds, you paid $180 in 10 years. That's $18 a year. Very inexpensive. But that's how they make their money. So they make those ETFs, they make those mutual funds, and because they have trillions and trillions of dollars, whether it's $18 a year times a trillion or trillion accounts or however much money they have, that's where they make their money. So when you buy and sell, in most cases, they're not making any money off of you. That's, again, it's super general. A place like Robinhood, they used to, I don't know if they still do this, they used to make their money in the cash that you do not invest. For example, if I have $100 in my account and I go invest $80 of it, I got $20 that's left. And what they used to do was they would have my money and not pay me interest. So they would kind of do some accounting things. They would go invest my $20 and keep the money for themselves that they would have paid in interest like a bank. So that was kind of innovative at the time. So I don't know if Charles and others do that, but I know for a fact, Charles, Fidelity, Vanguard, their money is in the retirement stuff. Their money is in their 401ks and inside of their ETFs. That's where they get paid. Me and you buying and selling stock, they don't care anymore. They don't make any money off of that kind of stuff. All right, I am scrolling back up to make sure that I didn't miss anything else. We talked about ETFs. We talked about the Roth IRA. Is it true you should only purchase REITs in a Roth IRA to avoid taxes? No. You can buy whatever you want inside of a Roth IRA because you've already paid taxes. So that's the thing. I'm not trying to bash nobody. I don't know where you got the information from, but that's the benefit of a Roth IRA. You've already paid taxes. So as long as you just invest and leave it alone and you keep the account for 5 years and you're 59 and a half, you do need to check those boxes, but you're really not paying taxes at all, which is the beauty of a Roth IRA. So you can invest in whatever you want to invest in inside of your Roth IRA. That's just standard. REITs are good. So I'm not anti-REITs. REITs are good. I have some. We've talked about those in the past. But yeah, get whatever you want to get inside of your Roth IRA, follow the tax rules, and you're going to be fine. All right, I already have a state pension, Roth 457B. That's nice. I like those. And let me see if I can get the whole comment here. If it allows me to, it won't let me see your whole comment. I don't know why. All right, so got 457. I'm rolling over to individual stocks. I'm wanting to learn Forex. What do you stick to regarding Forex and opening another account? So I am not a Forex expert, so I'll be up front. So I'm not someone that deals with Forex. I can attempt to find somebody that does. I know somebody who knows somebody who does Forex, and she seems to be doing pretty well. His name is Andre. He is the Millennials Next Door. He did a summit with someone who does Forex. So I personally don't do Forex. I have my reasons for it, primarily being as a top 100 financial advisor and someone who's actually seen what millionaires invest in and how they got there, and somebody who made those decisions for them. Not once did I ever see a millionaire that did Forex. That doesn't mean they don't exist. That does not mean they don't exist. I'm just playing the numbers. So if you told me that 98% of millionaires have index funds, own businesses, and hold large, well-known companies for X amount of time, that's what I'm gonna do. So again, I'm not bashing Forex. Excuse me. I will try and find the expert for you, because if they work with Andre, they are likely a very legitimate person. So I can go and try and find that person for you, but I just don't do Forex currently. Great questions. All right, so we are much longer than where we're supposed to be. I'm sure Instagram is mad at me. So we will come back tomorrow. I try to be here around 10. I was a little late today. My apologies there. Make sure that you share this video, grow the audience, and help as many people as we can. Again, my name is Kevin Matthews II, top 100 financial advisor, 2-time author, 1-time bestseller, And you want to make sure that you also go to buildingbread.com/streams. That is the link above to learn about how you can build and master the 7 streams of income. All right, that is it for me. I will see y'all later. Bye.